Hey family, welcome back to Debbie Productions. So for today's video, I'm going to be letting you guys know the major key differences between the foreign exchange market and the stock market. So before I begin, I would like to define two important terms that are going to appear across this video. The first would be liquidity and the second is leverage. Now, liquidity is defined as the activity level of the market. You don't want to put your trade into something that is not going to be moving. So you would like to have high activity level, high liquidity. So you see either growth or not growth, regardless, it's going to be moving. Next up is leverage. Leverage is defined as using borrowed money to enter into an investment in the hopes that when that profit increases in time, it's going to far outweigh the interest rate that would have accrued from the borrowed money. Okay, put it this way. Let's say I want to enter into a trade for $20, but I only have $10. I'm going to borrow the $10 it takes me to enter into that trade because I know it can potentially go to $50, $60, $70, and I can take that profit, pay the borrowed money back, but I was still able to make X, Y, and Z. Again, leverage is the amount of money you can borrow to enter into a trade. Basically using borrowed money to make more money as opposed to money that you don't have. All right, family, now I'm gonna get started with this video. What are the major key differences between these two markets? I'll start off with the stock market. So first off, what do you trade in stocks? When you're dealing with stocks, you're buying and selling a company's share. So you buy it when the price is low in hopes that when the company increases in value over time, you're gonna sell it at a higher price and take that profit. Okay, how much is traded in this market? $189 billion is traded daily in the stock market. You can trade stocks for an 8-hour window during business hours. That would be 9 a.m. to 5 p.m. and they're closed over the weekends. Now, in terms of the liquidity and leverage that I discussed at the earlier portion of this video, stocks have low liquidity and low leverage. Moving on to the FX market. So when you're dealing with foreign exchange currencies, you're basically going to be simultaneously buying and selling one currency to the other, depending on which economy you think is stronger or which currency you think outweighs the other. That's where you're going to be making your money from. $7.5 trillion is traded daily in the Forex market. You can trade FX 24/7. Why? Because the market opens on Sunday 5 p.m. Eastern time and closes on Friday 5 p.m. Eastern time. So the only day that you're not trading is going to be that Saturday. However, there are after hours trading. It's going to cost you a little bit more. The broker's going to charge you more to stay in there, but you can trade over the weekend. And currencies such as Bitcoin and things of that nature are also fluctuating over the weekend, so you can always make more money. In terms of liquidity and leverage, the FX market has high liquidity and a high leverage. What that means is that you're going to be seeing a lot of activity in this market. In addition to that, you can borrow a lot more money to hop into a trade as opposed to the stock market. That's the main key differences, family. Hey family, so that concludes this video. Thank you so much for tuning in. If you learned something new, please leave a comment down in the comment section. And if you didn't really understand a topic, I will be leaving a picture of my whiteboard at the end of this video. And in addition, just leave a comment if you don't understand, and I can always go more in depth. Thank you so much, family. Much love. I hope you guys have a great day. There's going to be more videos like this, so please stay tuned. Lil Debbie out.